London, Mayfair. Inside AIG Financial Products, Joseph Cassano holds a fax pulled straight from the machine. No greeting, no negotiation, just a demand from Goldman Sachs, $1.5 billion. Cash, now. Cassano spent years telling investors the risk in his division was mathematically zero. Tonight, that math is dead. The paper in his hands isn't a bill, it's a countdown. 72 hours from now, if this money isn't paid, AIG collapses. And when AIG collapses, the global financial system follows. There is no cash in the vault. The timer has started. AIG wasn't just another corporation. It was the Fort Knox of insurance, a century of history, nearly $1 trillion in assets. Airlines, skyscrapers, pension funds, governments, all insured by AIG. Its business was boring, predictable, trusted. That reputation became its greatest weapon. While New York sold life insurance and corporate coverage, a small London unit led by Cassano discovered something dangerous. They realized AIG's balance sheet could be used like an unlimited credit card, and no one was watching closely enough to stop them. Cassano's invention was called a credit default swap. The pitch was elegant. AIG would insure mortgage securities. If housing collapsed, AIG paid. If not, AIG kept the fees. Cassano was confident. U.S. housing had never fallen nationwide since the Great Depression. To him, this wasn't insurance, it was free money. AIG sold protection on over $500 billion of mortgage bonds. Bonuses crossed 7 figures, models confirmed safety. No reserves were built. Why prepare for something everyone agreed would never happen? Buried inside those contracts was the trap, collateral clauses. If mortgage prices fell, or if AIG's credit rating slipped, counterparties could demand cash immediately, before any real defaults, before losses were final. Cassano ignored it. He believed ratings would never fall, housing would never crash. AIG was selling fire insurance while standing in gasoline. As long as prices rose, the flames stayed invisible. Then, in 2007, housing cracked, and the phones started ringing. At first, the demands were small. Goldman Sachs asked for collateral, then Merrill Lynch, then more. Cassano fought back. He argued valuations. He dismissed the panic. But markets don't negotiate. Ratings agencies moved next. A downgrade would trigger tens of billions in collateral calls instantly. The CEO in New York scrambled for cash. But every hour, the hole grew larger than the balance sheet could survive. AIG was running out of time. September 2008. Lehman Brothers is already dead. AIG is next. But AIG isn't just a company. It's the backbone of thousands of financial contracts worldwide. If AIG fails, banks fail with it. Pensions freeze, credit stops, the system seizes. AIG stock collapses 60% in a day. Inside the Federal Reserve and the U.S. Treasury, panic replaces theory. Letting AIG die isn't an option, and the decision that follows will enrage the world. The rescue is unprecedented. The U.S. government injects $182 billion, taxpayer money. AIG is effectively nationalized, but the cash doesn't stay there. It flows straight through AIG to Goldman Sachs, Deutsche Bank, Societe Generale, paid in full. AIG wasn't saved for itself. It was saved to protect Wall Street from its own bets. Days later, executives approve luxury retreats costing hundreds of thousands. Public trust shatters. AIG proved how the system really works. Profits are private, losses are social. Joseph Cassano walks away with millions. No prison, no real accountability. $182 billion didn't fix the foundation. It bought time. The rules didn't change. They just became quieter. If you want to understand where the next bubble is forming and who will pay for it, subscribe. More investigations coming.